Hello and welcome to another episode of Securities Lending Live with Pierpoint. So thanks very much to everyone that's joining us. We're glad to be back again. As I said, this is 2 weeks in a row post-cerveza sickness recovery on my part. So again, to remind everyone, the objective of these events is to discuss relevant topics and themes, and we've got what many will probably think of as a controversial theme, or at least one that we shouldn't talk about. And those are our favorite kind of topics to talk about, because it also gets hopefully you involved, gives you a chance to actually share your comments and views. And we like to talk about the things that nobody else wants to talk about. So although it's live, it will, of course, be available for replay on LinkedIn. We're also on YouTube, and so it'll be live there as well and recorded. And I think we're also on Facebook. But apparently these days, Facebook will take anyone on their platform. I'll just leave it at that. Look, what we want is because it's live, the advantage is you can actually give us your comments and thoughts, suggestions, questions. Really important that we actually get that kind of feedback from you, because we can only reflect, our own thoughts. We don't want this to be sort of self-selecting. We want you to tell us what you think and how you feel. I'm always happiest when people are disagreeing, because that means that I have a chance to learn something. Now, if you see my eyes darting around, it's because although I'm trying to moderate the session, I'm also the producer because I'm cheap. So I have different screens around me, so I'm looking at them. And as I always say every week, I love every one of you that's watching this live or in replay. And I think the first good morning for the day is for Ludmila. So thanks very much for joining us. Pop it into the comments if you or where you're watching from. And we always have a lively debate between countries. So get your nation represented here today and now. The other thing I'd like to do is ask you that if you really like these sessions, if you think that they add value and are a good forum for sharing views and thoughts, please do us a favor and give us a like in the comments on whichever platform you're on. I'm going to now ask my colleague John to introduce himself. John, over to you.
Morning, everybody. For those that don't know me, John Arnesen. I'm the consultancy lead for Pierpoint, having spent prior to that most of my career running agency lending businesses for various organizations. As Roy said, there's only two of us today, so we are going to discuss a subject that is both uncomfortable or at least needs to be answered at some point. And please, I encourage you to really ask questions here, because we have no foregone conclusions about what we're going to talk about. But the facts do speak for themselves to some extent, so we shall see.
Okay, so thanks for that, John. I'm going to post up there today's discussion topic. The thesis is that demand is finite, that's borrowing demand, but that the supply seems to be growing as more investors get involved with the business. And we're going to talk about what the challenges and opportunities are that arise from that basis. So if you agree with that, that the demand is finite but supply is growing, put a comment in there. If you think that that's a little bit simplistic, also interested in hearing what you have to say. But John, why don't you just kind of lead us off and set the stage for that discussion?
Sure. So using stats that are courtesy of the various data providers, it's quite clear that in the last 3 years, revenue has either at best remained flat, but it looks like it's actually declining. And that followed a 6-year period between 13 and 19, where it actually grew year on year, with the exception of 2017. Now, last year, we know that short selling bans in Europe and parts of Asia had an effect on the market, but discounting that to some extent, because remember, we always talk about securities finances being somewhat, impervious to market conditions. It tends to be about volatility and not necessarily direction per se. But having said that, we do have a market that is producing less revenue. in terms of the market structure, it really is all about equities. I mean, I come from a fixed income background. I love debt. But the reality is that 80% of the revenue in 2020, which was about 9.3 billion in gross revenue generated, 80% came from equity. And of that, 51% came from US equities. In fact, it's US equities that was actually the success story last year, because revenue actually grew by about 6%. Or at least fees grew at 6%. I think the revenue was up about 15%. All other equity markets produced fewer fees last year, and there were some pretty horrendous stats. I mean, 24% decline in revenue in Asia, 25% decline in Europe. It doesn't really bode well, but we do have to discount the fact that there are some mitigating circumstances. I mentioned government debt. You know, it only represents 16% of revenue, but yet it has the highest balances in the market, and you can understand why, because of the size of the types of transactions that support the repo market, or even HQLA transactions. So it's to be expected. And actually, the revenue was up 8% last year, but it has the lowest fees of any asset class at 15 basis points. Compare that to US equities at 81 basis points, and it tells a story. So if we roll into this year, we know, I don't have the first quarter stats. I was looking for them, but I don't think anybody's published them yet. We know that April was a pretty good month. I just read that recently, that revenue is up 25% year on year, but a year on year maybe isn't the best benchmark to base it on. We should probably look back to 19 maybe. So what's my point? My point is that from all the stats that I can gather, collective investment schemes and pension funds represent 35 and 22% of all the supply in the market. And that's in fact reflected in the loan balances that these two have, respectively, at 35 and 24%. But the utilization in the equity markets is no higher than in any market than 5.5%. In EMEA, it's 5.4%. In Asia, it's 3%. It's about the same. And in the US, it's 3.3%. In a market with declining revenues, now I accept that could change, and we hope they do, but on the basis of that, dominated by pension plans and collective investment schemes, against the backdrop of the stats I've just used, why would any agent lender want to add new clients from these sectors? And why would I, if I am a pension plan or a collective investment scheme manager, want to join? Isn't the market evidently oversupplied? Roy.
Okay, well, I guess there's a couple of things there. So hopefully the scene that you've set in terms of declining revenues last year, I think you're right. I think Q1 year-on-year comparison is frankly almost irrelevant. I think that much more important is a Q4 over Q1 sort of pathway and trend. That'll give us a better figure, and there's some data out in that. But of course, Q1 was also skewed by GameStop and the meme stocks. You know, this year, I mean, yesterday, Korea lifted their short selling ban. Right, not yesterday, Monday, and so we saw some pretty big activity, and the same old names that were being shorted before the short selling ban, they were back at it. But look, you know, ebbs and flows on those stocks, so they were down and then up again. So we'll see. But at least the opportunity exists for Korea to pick up and fill some of those Asian revenue gaps that you talk about there. But John, I think you raise a really good point. We've had around 2 trillion of assets for several years on loan, and now, as you said, it's kind of more heavily shifted for the HQLA government bond side of things in terms of balance, but the revenue is pretty consistent. So we've got consistent balances, consistent-ish revenues, but supply keeps going up. And I think the last figure I heard was something like 25 trillion. So yeah, indeed, why would an agent want to add new clients? Why would a client want to take a meeting about having new assets? And why would there be new entrants? You know, why would Fidelity be announcing that they're going to start taking assets from investors outside the Fidelity group? And why would new entrants like ShareGain continue to grow? And we saw their announcement with Citibank not long ago. So geez, you know, this just doesn't really make a whole lot of sense.
I
or
mean,
does
in some ways, you could even go further, Roy, and say, you know, if I was a pension plan, listening to a pitch from an agent lender, and my first question would be, well, how many of my assets do you already have in your program? Because I know that if I'm heavily equity exposed, I know that the utilization is going to be no more than 6%. Well, am I entering that 6% and bumping somebody else out? Am I in addition to that? Because we know the reality of this thing, that as you add clients, you are diluting your existing supply. So as a pension plan, I might be attracted to looking at an alternative way to market. And I think it's fair to say that theme has certainly been, in the last year or so, quite a common theme, in that there are those that are offering different solutions. And I think perhaps they do need, for the first time, I'm an agent lender that was worked for global custodians. I think that is the route to market, but I have to admit that maybe it needs a revamp, or at least rethinking.
Well, look, I think there are a number of different ways to do this. One is your route to market, but there's always been alternatives, right? So,
sorry to interrupt, Roy. Is your camera dropped?
No, I still see me, but
Okay.
as long as people can hear me, that's all that matters, because I have a face for radio, so maybe that's actually a good thing.
Good point.
But look, there's always been alternatives. There's always been third-party agent lenders that don't need to be custodians, or in fact, firms like ESEC Lending, who came with a different approach originally in terms of how assets. So I think the market is pretty good at evolving and adapting. But I guess the real question is, John, if we want to take it a layer down, is it just that there's too much supply, and therefore why look at it? Or is it just that we're not targeting the right supply delivered in the right way?
Well, the utilization is the first thing to look at. Now, the high level stats, I think, don't really tell the picture, because we've all had clients in the past with the right assets have had very high utilization. Although remember, utilization in itself isn't a great thing. It's more about fee. But I think that the fact that utilization across the industry, even if there are pockets of high utilization, and of course specials can go really, really high, that's all well and good. But the reality is that it doesn't seem to be it doesn't seem to be growth in the demand side. It seems to be, as you say, Roy, that it seems to bump along every year. And let's not forget that the revenue that is generated is meaningful, but it isn't something that, if you looked at holistically as a business unit, you may think twice about investing in it, because it looks like it's just sort of not laissez-faire, but it's not developing at a speed that it probably ought to, or at least a growth rate that it ought to. Now, I think that you can't really do much about the current situation. You could probably tinker around with disintermediating maybe your agent and doing something direct. I do think that the peer-to-peer discussion that has been certainly discussed in the last couple of years probably has some merit to it, but I couldn't really speak to it because I'm not quite clear what's going on in that space. I think that all those things need looking at, because what are you trying to do with your assets? You want to be sure that if the demand is finite, that you are getting your fair share at a crack at the whip. And how you go about that shouldn't necessarily be pursued in the traditional way, given the stats that I mentioned. We have some questions coming in, Roy, which could be interesting. I haven't read them. I think you're on mute.
Thanks for that. No broadcast is complete without at least one person being on mute. I want to say hello, first of all, to Steve from the UK. And Steve, we'll get to your question in a second. Also want to say hi to Matt from Norway. And Matt's put in a really great scenario and sort of asked for comments. So Matt, basically what Matt's saying is that, look, apparently demand is finite, but really only the demand to borrow assets from the beneficial owners, whereas the organizational structure and the regulatory structure for prime brokers give prime brokers the opportunity to offset positions internally, the internalization process, and on synthetics, not just internalizing them, but also trading synthetics with counterparties to offset each other. So really, I guess what Matt's kind of posing there is maybe it's the traditional assets or the traditional structures that are actually finite, not the demand to borrow. What do you think about that, John?
Yeah, I think Mac's making a very good point, actually, because we always think of it from the structure that we know now. But what happens on the other side of the equation between after the beneficial owner and agent, the structures that are available to the banks stroke prime brokers are actually probably far more creative in things that they can do. So, to some extent, I think that's probably a very good point. I think that a lot has been said about UMR and the need for collateralization coming in from a regulatory development, and that somehow will help the market utilize more assets. Okay, fine, but we're still coming from a very low base of utilization, and the kind of assets they want tend to be used for other things. So I don't know that it's going to be very lucrative to do that either.
Okay, well, I think there's quite a lot in that. So let me add a few things. So number one, I'll come back, I think, near the end to this demand is finite, supply is growing in traditional activity, because as you know, and as other people will see me do, I love to rant about that topic. So that will be my closing rant. But this asymmetry of the regulatory treatment for synthetic transactions and securities lending transactions in the traditional sense is structurally an issue. So I think that is a hurdle that will remain until and unless regulatory rules change. And so that presents a challenge, I think, for the traditional lending community to say how are they going to face that. But let's peel back another layer, because what we keep talking about almost is as if all assets are the same. And I get your point on specials, but look, one of the big challenges and opportunities that I saw when I was in Asia was that the preponderance of non-MSCI tracking portfolios was much bigger. And one of the problems that you find in Europe and North America is most portfolios are structured on an MSCI sort of tracking or benchmarking basis. And the problem with that is that every portfolio looks like every other portfolio. So all you're doing is adding more of the same every time you add a new client. John, did you have the same kind of experience?
Clearly, many clients look and smell and feel the same, which actually gives rise to the problems I mentioned earlier, in that you have to have and we talk about, equal opportunity to lend, and that's built into some algorithm that everyone, I assume, is using, but not necessarily, because you have to demonstrate, regulatory-wise, you have to demonstrate that you are treating clients with the same opportunity to make a loan. And there's a whole list of reasons as to why that may or may not happen, which is way too long to get into here. I had clients, Roy, that were central banks that didn't track anything, that were basically stock pickers. And I'm talking about equities here as well, which is always good to have. And their utilization, because of the kind of assets and the size they had, was far higher than the rest of my client base. Notwithstanding the fact that they also held government debt of the right quality. So the HQLA opportunity was I had a utilization of over 95% for certain clients. But anybody that isn't tracking, and this is why retail is kind of an interesting sector because of the kind of assets they own, that's actually where you would see revenue and utilization rise.
And look, that is exactly the point. That's why we sort of pinged retail investors last year as having a big impact, because by definition, they're idiosyncratic, right? They select stocks that they want to select, irrespective of what the rest of the market thinks. And GameStop is, the embodiment of that, along with the other meme stocks. And I think that's why it's really interesting to me to see that, the Schwab results in Q1 were the highest fee earners of any agent lender in the business. And that's driven off the back of retail clients, both the Schwab ones plus the ones that came along with the TD Ameritrade acquisition. And I think that it's not just the US, right? In my blog yesterday, one of the things that was, I think, really stark when I was investigating it was the importance of retail investors in Korea, right? They have, in terms of their market share of the equity market purchases, they dominate, right? Foreign investors, domestic institutional investors, way outpaced by retail investors. And if you now say that they can actually go long, or sorry, they can lend their shares, but also go short, I think that bodes potentially really well for Korea. We've seen it in other markets, and I think retail investing is a trend that will have a big impact on lending supply.
Yeah, I mean, absolutely. The Middle East, for example, is very much dominated by retail activity. If I was really thinking about how to generate additional revenue or protect the revenue I have through doing things differently, I would spend a fair amount of time trying to work out how to attract local supply in local markets that are developing or emerging. Onshore lending. Now, there's some complications to that. I get it, but that's probably where you're going to find in these emerging markets, emerging from a lending point of view, where I think it could be quite lucrative. I can keep on doing what I just talked about earlier with these low utilizations and declining revenue, but you're going to have to branch out of that, because there's a question here from Steve, which I think we'll get onto, but the market may be on the cusp of some change in terms of how it operates. I think if we're having this conversation in 5 years' time, shoot me in the head. But in 5 years' time, we are going to be talking about operating over over DLT with digital assets, with no movement of securities, and everything's going to be tokenized, I think. And maybe it's not 5, maybe it's 10. But the preparation for that is now.
So now you're kind of moving into a different realm, though, because in order to enable that, you need to have a different technology infrastructure. And we've talked about digital transformation. So maybe we'll come back to that in a moment. You touched on new markets. So if we look at the announcements in China, of sort of greater sort of ability for participation in the Chinese market, Saudi, who have been working for a number of years to kind of smooth the process to cash market transactions, to augment and sort of perhaps to a degree replace the synthetic activity that's going on there. Philippines coming later this year. I've done work with the people in Nigeria. So is some of it, John, just sort of targeting the right assets? And if so, are those assets going to be coming from non-residents?
I think to answer that question, Roy, you'd have to look at what are your current clients' holdings in those countries represent. I mean, every time I got excited about a new market, it was all well and good until I found out that I had no client with any kind of holding in any of the countries that we were getting excited about. That clearly will change, but I think fundamentally, as we discussed a little bit last week, markets that are emerging or moving from frontier to emerging market status, with an ultimate view to be included in the MSCI World Index, are going to be very cautious about how they introduce certain products to the exchange. And I think the ability to lend or to go short is one step in that journey. And as that happens, and as those markets become more liquid, and we would argue that the securities finance part of that assists in that, then I think you attract clients that are probably going to be look at buying in those markets. But I think it's a slow progress, and it's all very well if the Philippines we can break through to the Philippines and lend in the traditional way that we want to. I suspect we won't be able to. But if you don't have clients that want to hold Philippine stock, it doesn't really make any difference. China's going to be a whole different kettle of fish, because I think there's far more depth to investment there. But you're driven by your investors. You're investing institutional clients to some extent. So they go hand in hand.
Okay, thanks. I'll come back to that, but we've had a number of people join us live, so I just want to repeat that what we're talking about here today is securities lending, and the question or the thesis is that the demand to borrow assets is finite, but the supply just keeps on growing. Does that make any sense? We had a great question from Matt. Matt's had to leave, but he posed the proposal that, in fact, there's no shortage of there's no dearth of need to actually borrow assets and take short exposures. Perhaps what's happening is that those short positions are being expressed differently through internalization and synthetics. And
sorry, Roy, I didn't mean to interrupt.
Yep, go ahead.
On that point, though, borrowing a security is actually kind of a pain. When you think about the mechanics and the infrastructure that's required, and settlement, and then mismatching and failure, etc., wouldn't you argue that a synthetic exposure is actually so much more hassle-free that there isn't more? I'm surprised there isn't more of it, or is there? And we're just not seeing it.
Well, there is. I've argued for some time that, in fact, all of this chat about how the market isn't the size that it was pre-Lehman, I think is just wrong. I think that the market actually probably is at least as big as it was then. It's just different. It was obvious then, right? You had big proprietary trading from banks, so it was sort of in your face in the market, and now it's not. And I think that's the issue. And I think the best way to show that that's the case is, it was last year even that JP Morgan said that more than half of their revenue came from synthetics in this space rather than in the cash market. So I think that's kind of your measure there. But John, I want to pose something that I've heard from clients, and I think there's some real strong validity to this argument. An agent lender, when determining whether to go into a new market, is, as you say, they're going to look at the supply from their clients, but they also have quite a lot of work to do. They have to do their due diligence on the legal and the tax environment, as well as the operational processing. And quite frankly, the fee split share is so low that in a new market, it doesn't become economic to participate for ages, because that first loan is great, but if you spend 50 grand, 100 grand, whatever it is, doing your due diligence to open up that market, you're not going to see that back for a long time. So it wouldn't surprise me if people said, well, no, that market might be coming, but I'll push that down the road. And that might be sensible from an economic point of view for the agent. But for an investor who has a big exposure to that market, they might go, well, what about me? It's useful for me and my fund. So isn't that a dilemma that might have an influence here?
I think it's a constant dilemma. And, it's a shame that Matt's left, because he would be a great example of that. Given the size of the fund's holdings in certain markets, they could drive the agenda to some extent. And I think in the past, they probably did. When I ran my last organization, we kind of had a sort of unwritten rule about when are we going to look at a market in terms of our supply, and if any single client held, the majority of that of the modest holdings we had, it wasn't a great story, because if we had an even distribution of clients that held in a market we weren't lending in, we got to a size where we thought the work that you described, Roy, could be done, because it is expensive and it does have a cost to it. That drove our decision. But I have to admit that if you if the market in Taiwan is producing 400 basis points for a transaction, but you've got 90 million of holdings, you're not going to do it. Now, what happens to those clients that maybe have 88 million of that 90? Actually, that's a bad example. It's not enough. But there is a critical mass that's needed to do the work. And I think you could, if you can't solve for those issues for clients, that's where, what alternatives do they have to get that exposure from a lending point of view? Which is why maybe there is maybe you do have a piecemeal approach to how you lend your assets. If you've got, you let your custodian lender do the bulk, the heavy lifting of the obvious markets. But if they can't provide that service, look for alternative. Why not?
And Taiwan, although your numbers maybe it didn't work out. The reality is Taiwan started off with access products before securities lending was really really possible, and it's really, that's an example of the innovation that ends up creating a need. If people want to have short exposure, they will find a way to do it, assuming it's legal. And Saudi's another good example where it hasn't been allowed in the cash markets, but there's a meaningful and significant short exposure through synthetics, which again the regulators are aware of, and they accept as being part of the market, and as I said earlier, are allowing it to facilitate. But look, I think this is where domestic market participants really can drive the case, because the concern about emerging markets in particular is it's hot money. And regulators are concerned about that domestically, exchanges, politicians. They don't want money flooding in as a market becomes hot only to disappear later. Whereas domestic investors are in those markets. They have the depth, breadth, and stability. And so I'd like to see more work done on domestic firms in each of these markets to develop that domestic sort of client base. So, John, you spent time in various countries in Asia. Was that kind of a similar theme for you?
Yeah, we pursued that with real vigor over the years, recognizing that having local clients with local assets would actually be something of an advantage to both us, the clients, and the reality was that I found that a lot of my Asian clients had exposure to Western stocks. And a lot of Asian clients held the debt of Western nations. So in fact, there was a reverse going on. I never really successfully found, although there were clients that we came across that were, in that domestic market with domestic supply, and that I wanted to, if I was going to do it, I wanted to lend it domestically onshore, and yet we didn't have the capabilities to do that. I would spend my time and efforts, if I was in that position now, to pursue that with more rigor. I think that's where you're right, Roy. I think that's where those markets probably tend to. That's how those markets will grow. And also, you can't be accused of, as you say, that those assets are probably there to stay. And I'm almost arguing for breaking up a concentration of maybe desks in 1 or 2 or 3 locations into more offering local solutions to local markets. It's like the argument that we used years ago internally, where our Italian sub-custodian in Italy, when you think of all the banks you could have used, had to be Citi. And why? Because Citi had bricks and mortar and expertise in every single market in the world, because that's how they went about how they didn't omnibus their custodian structure. They put it locally. And our Italian colleagues used to say, well, how can that be the case? And said, everyone uses Citi in Italy. And I think you could use that analogy for lending. I think you ought to, maybe in these markets that are emerging, maybe you ought to be there, because I can, lending Vietnamese securities from a desk in Japan is probably fine, and you may not want to be in Vietnam to do that, but you could. But having local market knowledge, I think, is probably the way to go.
Yeah, this is not a paid advert for Citibank, but
not at all.
30, I don't even know. In the late 80s, let's just leave it at that. Late 80s, I was working at a custodian bank, and I was really critical because one of our biggest competitors was Citibank, right? So I think that year we had lost a really important account to Citi, or we'd split the relationship. They used to be just ours. And so I was critical because I was of the network selection process, because I was the one that was communicating to our clients when we added a new agent or a new market to the platform. And I said, why would a client come to us if all we end up doing is giving the assets to Citibank? And I was quite critical internally, and they finally said, I'll tell you what, Roy, we're now going to look at Hungary and Czechoslovakia. Was it Czechoslovakia? I think.
Well, it could have been back then.
At the time. And they said, so you go on the trip and you tell us. So I went on the trip. We went to the 2 countries. We saw the domestic banks, and it was like, okay, now I understand why we select Citi. And that's so I think bricks and mortars will certainly has had an issue. But let's get back to Steve's question. So Steve has basically said that, look, two different issues. One is kind of the tech itself, and you were talking about, DLT and immobilizing assets, and we've seen what HQLAX is doing in the market today. So one is just the technology side of it. The other aspect, which Steve touched on earlier, is digital assets themselves and the potential for borrowing and lending activity in there. So I'll just give you just a bit of a background, because I've done some work with an entity in the U.S. that wanted to start up as a digital custodian. So I've done some kind of groundwork on there, met with a number of institutions, and I think, look, we can see, particularly over the last 6 months, that there's a greater institutional acceptance of digital assets, but it's still pretty slow. It's still very much the early days. And from what I've seen, it reminds me of what securities lending discussions were like in the early 90s. But today, everything compresses. So if it took us 20 years to get to where we are today, it certainly won't take anywhere near that time to look at digital assets. But I think there's still question marks of digital assets. There's still a question to some extent about the safety and security. And so whereas a custodian bank can say for traditional hard assets, yep, no problem. If we go insolvent, these are ring-fenced assets and available to you. That same environment doesn't exist for some digital assets, and so insurance comes into it, and there's a finite capacity for insurance. So some of that is just structural, and will have to evolve as we get different legal structures. Having Malta or Gibraltar as regulatory environments will be okay for many, but not everyone. Right. So we see regulations evolving, and maybe some of the stuff you've looked at with the central bank digital currencies can form that. So I've kind of rambled a bit. What do you think, John?
The amount of column space in the press given over to this debate is endless, because I read a lot, as you know, and it's unprecedented. I mean, it's just there's so much buzz around this, and it's for good reason. But you're right to say that the evolution of this, Roy, I think, is going to be, it has bumps on the way, because you have to convince a market to make this transformation, and the trust and safety issues are going to be, hard to. You have to work through those, like with anything else. But we see the start of that in the securities finance markets already. We've already seen the certain entities coming with a digital solution to certain transaction types. That will continue to evolve. I mean, I'm referring particularly to HQLAX, and I think the share gain guys will argue that they have a digital platform in which to transact. That can only grow, but you're talking about a wholesale mind change. And as we know, that if anything is a reactionary market, it's this one, because we're still operating and transacting and settling exactly the way we've done for years and years and years. Now, what will give first? I suspect that you have to start this journey with the transformation at the global custody level. So I think that's where the effort will lie, in the sort of disintermediation of the actual transfer, to a digital asset representation as opposed to the asset itself. But that's going to take change. You have to be able to settle, right? So that's where it will start, and I'm sure every single custodian has a lab that is furiously working on this. But I couldn't give you a time frame for that. I know it's inevitable. I just don't know when.
Well, yeah. So look, I think, as you say, things are already changing. I think we will find the business evolves as it follows the money. I mean, look at Jamie Dimon, who was very insulting to digital currencies, and now kind of said, yeah, maybe I was a little bit harsh. Right, so you see that, and all of the main big banks that really provide legitimacy to this kind of new activity are kind of they're involved with it now, right? Everyone's got a desk to trade, and I think if there's revenue in it, the infrastructure will follow. We hadn't planned on talking about this, but the whole settlement issue is a really good one, right? If you look at traditional assets, DTC is really accelerating this idea of going from T+2 settlement to T+1. And one of the counter arguments to that is that's great in a domestic market, maybe, and arguably not for everyone, but generally you could see why it would be. But any non-resident investor still has to do FX, and that's still T+2. So you can't just take one piece of it and say, oh, this would be better. There's a big ecosystem, and that's in traditional assets. You talked about digital assets moving more quickly or not having to move at all, right? So I think this is a pretty important battleground.
But Roy, wouldn't you argue that the whole settlement infrastructure as it is now, where most markets are moved from, you'll know back when T+5 to 3 to 2, many markets are still T+2. You have to kind of solve for that first before you can go any further. And you're right that the currency issue is also needs to change. So therefore, should that be done through central bank digital currencies? Because I mentioned earlier about the press giving over to this debate. Most articles are about what's going on in the payment world, because the way that we make payments and cross-border transactions is kind of archaic. And if you can solve for instant payment, instant transfer of that kind of payment in that sense, then you can start thinking about T+1, T+0. But something has to give first. So you're right. I think the infrastructure needs to be prepared and ready for that. But it's a lot of investment and it's a lot of work.
Yeah, and Steve's made the comment that a lot of this will be dictated by what the CSDs themselves can actually do.
Absolutely. He's absolutely right on that.
And that's the point. And the reality is right now, there just isn't the processing capacity to meet compressed timeframes for the kind of volumes that these markets see. So we need to have more exponential kind of efficiency improvements in some of the replacement technologies. But that depends on individual aspects of the value chain, right? You're going to have more trades than you're going to have corporate actions. You're going to have more corporate actions than you are going to have of dividends, right? So everything is relative, and that's why I think an interesting approach is sort of a piecemeal, highest pain point
focus.
Really is the thing that is more likely to resolve the situation than kind of big projects. I actually almost used a bad word in that. So big projects, not big anything else projects.
So Roy, bringing it back to the original thesis we put forward, do you think that when this transformation is made or is becoming embedded in the way we operate, that actually we'll find out that the demand isn't finite and that it opens up doors in a way that is there an operating structure now that is actually frustrating demand?
Yeah, thanks for that, John. And that's our argument, right? I think we feel pretty strongly that trade execution, just getting the trade done, is pretty darn efficient. If you look at the difference between the fastest, most effective, and the least, I think that's a fairly narrow gap, and so that's pretty darn efficient. It's enabled by things like Equilend to be able to execute trades on an automated basis, and there's lots of bilateral efficient execution going on. So I think that piece of it pretty much in hand, and there's solutions for it. But I think that the trick everyone is still missing is that our issue is it's too expensive to run a physical securities lending transaction in the post-trade environment with the infrastructure that's existed up until now, right? To get that trade done, we focus on that trade execution, which is like just day one and just a nanosecond of execution, pairing, matching, and executing. It's really the next 15 days, 30 days, 100 days, or in fact, 2 days if it's a systematic trader that has lots of turnover. That's really the expensive part of it. So you have to unpack all of that and say, well, how do we make that less expensive? And I think SFTR, much as it, I've been, anti many parts of it, just to be clear. The reality is it started the process where we can have a much more efficient environment where everything is understood the same through the use of a common domain model, that the breaks, the errors, and therefore the timing you can do to execute this will be brought in. Fewer reconciliations, fewer problems, fewer errors, fewer fails. The environment that has a lower operating cost will be the environment of the future. And I think once you start reducing those costs, that some of the gap that the regulatory advantage of synthetics have will disappear, not go away. Until regulations change, that will always be an advantage. But the majority of transactions will still require traditional securities lending, because there won't always be an offsetting position there, or banks won't always want to trade on their books. I think just like stock exchanges computerizing in the 80s, decimalizing thereafter, that created an environment which facilitated algorithmic trading and HFTs today. When they computerized in the 80s, they weren't thinking about HFTs or algos, but that work enabled the environment that we're actually in today. And I think the same thing, if we can reimagine and reinvent what happens with securities lending, and the post-trade providers are definitely making good progress in this direction. I think DLT as an overlay on that will be an important next step as well. I think all of that together will then enable people with other trading ideas to come into the market and lift that demand sort of stalemate where we are.
Yeah, and you're absolutely right. In terms of, if you look at the products that both, for example, Equilend and Pyram are developing, it's to the very point you just made, Roy, that they recognize that there is friction, and they're looking for ways to make this thing as frictionless as possible by essentially taking out the classic elements that always make things fail or fall over or don't match, etc., or billing issues at the end of the month. I mean, the easiest part of securities finance is to actually lend the security. It's the rest that costs you, particularly in fails. It can be quite costly. And if you actually, I sometimes wonder, if you actually looked at every single securities loan you have on your books and its duration, and then given the fact you're giving the majority of that away to your underlying client, you wouldn't do half those trades probably, because you're actually not making any money from them if you knew the cost of your per trade ticket. And I think that eludes most, because you don't actually know what that is. You have huge amounts of costs allocated to you. Somehow it's all got to get paid for. And the only way to solve for that is through tech.
Yeah, so what you're saying, John, is that understanding of the cost of trade might be the next step that enables future progress.
Absolutely.
Okay. Good. Listen, hopefully those of you that are actually watching this live or on replay, hopefully you find this interesting. This is, I just put up on the board there, the Pierpoint Alpha community, where we do tutorials, editorial comment, community forum, and we do Q&A sessions. So we do these things for this community, right? So the idea is discussion and debate, sharing of information. John is our designated reader, puts in all kinds of interesting and relevant stories, posted up into the forum, and there's been lots of chat on the forum about the LIBOR transition and impact on cash collateral, for instance. John, you mentioned the peer-to-peer side of things earlier today. I do just want to do a big shout out for the Peer-to-Peer Connections podcast on the topic of LIBOR transition. They did They did one recently led by Jerry May, talking about the impact on a real investor of the transition on cash collateral. Matt, who was on earlier here asking questions, he did 2 absolutely outstanding podcasts on how Norgus approaches securities lending, and I really recommend that. But look, to me, we talked about emerging markets. To me, this is a much more global business, touching more places than ever before, and that's what the PAC, the Pierpoint Alpha community, is designed to do, is to actually give people a safe, curated environment to ask questions, to share their own expertise and knowledge, and to learn more about the business as it develops. And we look at digital assets as part of that as well. So if you're interested in learning more, go there. And we do these sessions every Wednesday, as I said, every Wednesday at 10 a.m. And we've added something new, which is an Ask Me Anything session, because I don't do anything on Saturday afternoons at 1 o'clock. We launched a half-hour session Saturdays at 1 o'clock on YouTube. So you can find me there and ask any questions that you have there. But John, maybe you can just, as we kind of sum up things, talk about maybe where you see the future of lending supply, whether you focus on the composition of it or the targeting of it or structure. Just where do you think we go from here?
I think you have to kind of recognize where you are in the value chain. If you are a large agent lender for a large global custodian, you're going to have an enormous program with hundreds of clients, probably holding relatively the same assets, and therefore you have a structure with your counterparties, your prime brokers, that you probably move a lot of securities. And I understand all that, and I think that's fine. I think that those entities will probably be more choosy about how they add to their program. And I think they probably have the bandwidth and the resources to maybe do some of the things we talked about earlier, which is target, markets that are either emerging or perhaps have interesting assets that have potential in the future. Because adding more of the same with the utilization levels we talked about, to me, makes sense. And actually, it's worse, because if I was a client, my first question would be, what happens to me when you add a new client to the program? Don't I just get less opportunity? And I think you never see that question in RFPs. And it's the first question I'd ask is, how many of the clients in the program have the same assets as me? Because I want that question answered before I enter that program. So I think that depends. But if you're a emerging, or if you're a more modest lender with maybe some interesting assets that aren't necessarily tracking, you probably have a greater opportunity to have a very successful business. But you still have to answer for the question: are you going to attract more clients with the same you always want to attract clients with assets that you don't have large holdings in, which is almost damn near impossible to do. So, but you may be more nimble in certain ways. I mean, it's really about what value do you represent to the borrower? Because the borrower has huge amounts of ways to borrow. We mentioned some of them that don't necessarily mean the underlying security. They probably have 50 or 60 venues they could go to borrow that security. So you've got to be relevant to your counterparty. And if you think how it used to be back in the 90s and 2000s, when it was the agent lender driving the agenda, it's no longer the case. It clearly isn't. So there maybe have to rethink that relationship, or at least we have to give more than just lip service to platforms that are emerging that might have an alternative solution. Particularly if you're a beneficial owner, you have more opportunity now to look at a non-traditional route to market. But you've got to satisfy all the risk management elements that are critical in making that decision. So I think there could be more of that in the future. I am interested in what peer-to-peer is attempting to do, because it is slightly a disintermediation, but maybe not so, because the infrastructure has to be used as well. I mean, I thought it was very smart of JP Morgan years ago to talk about offering their clients different ways to lend securities and just use their plumbing, because it's already built in there. Because even with those platforms that maybe are trying to attract clients directly to the borrower, someone's got to have the infrastructure to settle. So that's my thoughts on that.
Because I think that's a great explanation, and you're absolutely right. I think many banks will be looking at themselves and say, "Wow, we got this pretty slick engine here." It's almost like the argument of, dare I say it, Elon Musk, that your car sits there empty or sits there idly 90% of the time, and 10% it gets utilized. So why not mobilize all of the assets? And I think the same way that you were talking about with JP Morgan, where they said, we have a pretty slick operating infrastructure. What we need is more throughput, and that might be in multiple ways. And I think many banks are actually saying that to themselves these days, because you've got the overlay of SFTR costs. So your costs have just gone up, revenues staying flat-ish overall. So how do you get more activity? Interesting to see the Fidelity development. So I think there's lots of change going on at the moment. But to me, I think one of the things that we haven't talked about, and is subject for another session, is you and I have talked about the potential for a Japan-like two-tier market where you have callable and non-callable stock. And I think one of the potential trends is that some investors will become more active voters. And the reality is, if all that does is pull good supply out of the market at every AGM, that's going to be a problem for the market. So the question is, will there be a gap that gets filled by new supply, what otherwise would be not particularly great new supply, except for the fact that it might replace assets that now were being used more actively by the owner at times. So you find kind of this, I have stable assets that I'm not going to recall, and I have big stable assets that I am definitely going to recall, so I'll get rid of it cheaper, and you just kind of have that growth. Do you think that's a potential outcome? Just a yes or no, because we don't have much time.
Possibly. But the way to solve that, Roy, tokenize it and don't move the assets so you can vote on everything.
Well, tokenization. So I think we've got a few episodes ahead of us just to explore this issue. Again, thank you to everyone. We're just coming up to an hour. I could stretch it out, but I will grant you back your few seconds of time. Thanks very much for watching, John. I really appreciate your inputs. Some fantastic questions from the audience. Again, give us a like if you can. Follow us on Twitter, LinkedIn. We're just about everywhere you can possibly find us. If you're interested in doing the Ask Me Anything session, that's on Saturdays at 1 p.m. on YouTube only. We're always here on Wednesdays at 10 o'clock. Have a look at the pack. Imagine yourself a year from now. Would you rather know more about the business or know less? Because some of your competition is already making that step or taking those steps now. But again, thank you, John. Thank you, everyone, to the audience. And that is a wrap on
Thanks very much, everybody.
Pierpoint.